Hello, class. Here is the practice problems for long-term assets and impairments. We're going to go through how we might accomplish this and do that correctly. So we have a bank making a loan. We have the original amount. We have them making payments, equal payments each month for 10 years starting on April 1st, 2014. So first thing we need to do is calculate the payment on that, which we learned in our present value and our work we did there. So if we look at how we might do that, if you look here, we use the PMT function. We took the 5% interest, we divided it by 12 because we need to have monthly payments. We took our number of years multiplied by 12 to get the number of monthly payments, so it's 120, and the amount of the loan, $500,000. We got a payment of 5,303.28. Then we built a amortization table starting with April 1st, 2014, and figured out what the balance was after each payment. And then you do that, you simply figure out what the interest is starting on the $500,000, and then you subtract the amount of the interest from the amount of the payment. The rest is principal. That's how loans always work. And so you have a new balance, and that's going down over time. So we're going to come down here to make 34 payments. Count them up however you want to do it, but you end up with 382,649 as the amount that is the balance after those 34 payments, which is after the payment for January of 2017. Now, we're not going to quibble about if you counted it a little differently or whatever, but that's how you get the balance of a loan after several payments. So if we go back and see here, here's the problem. We've paid the late fees. We haven't paid that many payments. It's now August. The Bank of Leola has not received anything, and finally we're going to get some response from them. So they owe us interest from basically, they pay January payment for January, February, March, April, May, June, July, and now we're in August 1st. So it's just July, 7 months. So we look at that, we add to that, looks like we counted up a little differently. Let's change that to 7 months, and that's our amount. So remember, accrued interest is always included in the loan. How much interest from the last time we made payments is always considered when we're looking at the loan for impairment. Now, when you consider a loan by any bank, there's always going to be the result of any change to the terms of the loan is always going to end up being a loss to the bank. There's no borrower that's going to agree to pay the bank more than they would have otherwise, and the bank can't compel them to do so. So in any time that there's a negotiation, there's always going to be a better situation for the borrower, worse situation for the lender. So that means that there's always going to be a loss. So here's the amount that we're looking at. We're going to use for comparison purposes. We're going to, first thing is that the borrower makes an offer, $3,000 a month, August 1st for 10 years. Okay? So if we accept that offer, then what's the new value? So to figure out what the new value of this loan is, the amount that it's actually worth, we have to use the present value function. We use 5%. You always use the old rate. Doesn't matter what the new rate is. divided by 12, 120, and then we take the new payment, 3,000. That's the proposed new payment, and that means that our present value of this loan is going to be 382. This is what it should be. This is what costs. This is what the interest involved. This is what it would be if we accepted this new deal. That means our loss is going to be the difference between those two of just under $111,000. All right. Then as the payments are made, we go back to we calculate the payments at 5%. As far as I should say the interest, the payment is $3,000 if we go with this scenario. So our journal entry for the bank, we would receive interest. So we would debit cash 3,000 and credit interest revenue for this amount, and credit the loan receivable for this amount. And then the next month it would be these amounts. Notice that the loan amount is going to go down by the amount of the principal, just like we did over here on the amortization table each month. And so the interest is going down. This is what would be on the balance sheet for Leola Bank as the loan receivable. So when you record this loss, you're going to debit loss and credit the note receivable. Okay? Now the bank comes back with a different offer that's a little better for the bank, but showing good faith, wanting to give a better deal. So this one is going to be at an interest rate of 3%, same 10 years, and we're going to forgive some accrued interest. So we're going to base our payments on not the whole amount. Okay, so we're going to go back to the 382. We're going to calculate the payment here using 3%, 120 months, and the amount without the accrued interest. All right, we get a payment of $36.59. Then to get the value, see, in the first example, we knew the payment already, $3,000. But in the second example, we don't know the payment until we calculate it. Once we have that payment, then we can figure out the new value for Leola Bank. We're going to use that, but notice that whenever you calculate the new value, it's always at the old interest rate. So even though 3% is what we're talking about to the customer, it's still on our accounting 5% divided by 12, 120, and the new payment. So the new value you see here is 344. And again, if you don't like it to be red, you can put a negative sign in front like I did here, or you can use a negative payment, whichever. And notice it's a little better. The value is higher and because of the higher payment. And so the loss to the bank is only 48.8. So we're going to debit loss and credit the note receivable. And then as we receive payments, we're going to debit cash and credit interest revenue and credit note receivable. All right, and then the next month it will be a little slightly less interest, slightly more principal. And if we did that for the whole 120, this would go to zero, just as we expected. So that is the way that a bank approaches loans and the possibility that they're impaired, given that there is a negotiation of terms. Now, other assets such as long-term assets, as patents or intangible or tangible assets that are not loans, have a two-step process to see if they are recoverable and then to figure out the new value. But it's very similar as to what we've done here as far as calculating a new value for any asset that may be impaired. It's just that any change, it's a lot easy, real easy to tell if a loan is impaired to the bank because any change to the terms means it's impaired because, like we said earlier, no change would make the bank better off. All changes would make them worse off. So there is always an impairment if there's a change in the terms of the loan. That is not necessarily the case for those other assets. All right, so stop there. The other examples are in a explanation or in a second podcast explaining the capitalized interest, the asset retirement obligation, and testing a tangible asset for impairment.